Yo, what's up, guys? The market just closed and stocks went absolutely crazy today after we got the CPI numbers. And to be honest, the CPI numbers, it was like a mixed bag. But either way, the QQQ and the SPY just hit all-time highs today. And I want to tell you, the stock market is not at all-time highs when you inflation adjust it. If we go back to the old all-time high and add 30% to it, we're still kind of off all-time highs. So the bull market could keep going, but my stock portfolio actually just hit an all-time high today. So I can feel like a genius, but I didn't really do anything. I've just been holding my stocks. But I want to go over a few stocks in particular today, show you how the market's doing. Like, look at Bitcoin on the day, it's up 6.39%. All the risk assets seem to really like the CPI numbers or just today. And we now own Meta stock. That one is a dividend payer now. The yield is actually 0.6%. Oh, and I also want to show you my Moo portfolio, where once I buy a stock in here, I'm never going to sell it for the rest of my life. So if you want to subscribe and watch along the journey, I'd really appreciate it. But look at the total position profit and loss. We're now $400 in the green. Now, we've had some really good stocks and some really bad stocks. Like Perion Network, we're down 52%. And I looked at their earnings, and I think all the bad news is priced in for this stock. I was buying this one every single day. See, this is the true definition of dollar cost average. That's what I recommend if you ever want to buy a stock. Hashtag not financial advice. Just slowly dollar cost average into the stock. We also have some really good performers like DocuSign stock. I wish I bought more, but if you're into technical indicators, maybe you'll like this, or I don't really do that, but it says this is really bullish. And check this out. Here is actually my entire portfolio. We're over $20,000 now, and it kind of breaks it all down so we can see my total return from every stock right here. This is a free app. They didn't sponsor it or anything, but I just want to show you these are all my holdings, and I want to show you what I think you should do when you look for a dividend stock. Because if we head over here, my largest holding out of all my portfolios is ticker symbol CSL or Carlisle. And they're my largest holding because of their financial condition. And I'm going to show you, you're going to be impressed of how they're doing financially. And that's what I think you should screen for your stocks. So this is my absolute favorite metric to look at. It's known as the free cash flow per share. And check this out. They are growing this like crazy. It's well above the 2019 level, and it's well above their dividends. So this is what I love. Companies that just have so much room to raise their dividend, like they could afford to double or triple their dividend right now very easily. So their dividend cost 85 cents. Oh yeah, this company's been raising their dividend for 48 years, so they're almost a dividend king, but their dividend cost 85 cents, and look how much free cash flow they're making. And since they have a super low payout ratio, what are they doing with the rest of the free cash flow? Well, they're buying back a ton of their own stock. Look at their diluted weighted average shares. You actually now own 5.65% more of the company. We can verify this. Look, they spent almost $1 billion in the past year buying back their own stock. So the point being, if you have a long-term mindset, you want to find stocks with low payout ratios that are also buying back their own stock. And I want to show you one stock to recommend that I also own. It's EOG Resources. It's one of my smaller holdings, but this company has a rule that every dividend investor will absolutely love, that 60% of all free cash flow that they make will be returned to the shareholder either through special dividends or stock buybacks. And this is the free cash flow per share metric. So they're going to return 60% of this $5. And here's the proof of that. They actually have a huge history of doing special dividends, and most recently they've been doing a lot of stock buybacks. So let me show you the numbers for that. So here's their net income, $1.79 billion in the most recent quarter. So $1.79 billion, and they bought back in stock $759 million, which if you looked at the market cap, it was $75 billion. That means they bought back over 1% of the entire company just in one quarter. Think about that. 1% of the entire company is now gone. They bought it back. And check this out. This is their normal dividend when you exclude the special dividends. It cost $525 million. If you're looking at all those other quarters, you're like, why is it more than that? Those are the quarters that they chose to return the free cash flow to the shareholder in the form of special dividends. And on top of that, they're organically raising their normal dividend. Like their actual dividend yield is 2.82%, and that's 91 cents. So 91 cents per share, that's easily well covered by the earnings per share and the free cash flow per share. Matter of fact, they could double their dividend right now, no problem. Think about that yield. That's almost a 6% dividend yield, and they're choosing to not do that right now. They're choosing to slowly raise the dividend and also return money through special dividends and stock buybacks. So this one is I'm super bullish on, but they're also in the oil and gas industry and the commodities. So if you don't like that, I would do your own research, but they have some super premium assets. And let me show you what this one article said about their, look at this. They have strategic shift to double premium wells. I mean, hey, that sounds bullish, right? And if we head back over here, our second largest holding, it says, is actually ticker symbol AFG, or American Financial Group. And I want to show you why. If you're a dividend investor, you're going to love this stock as much as I do. That's why it's my second largest holding. And it's because of their dividend history, and specifically their special dividend history. They have a huge history of returning massive amounts of money to the shareholder. And guess what? They could easily afford it. Like, they just did a $2.50 special dividend. And let's go look at their free cash flow per share. So in the most recent quarter, it was $1.27. So this is the thing. Their organic dividend costs 71 cents and the yield is 2.17%. But their normal dividend costs 71 cents, and that's still easily covered by the free cash flow per share of $1.27. And if you look at the 2 quarters before it, it was nearly $20 just in those 2 quarters. That's just how insurance companies work. You'll have to sometimes pay more this quarter, that quarter. But if we look at their EPS, it's pretty stable and well growing. It's up 16% year over year. And for insurance companies, you want to look at something like the total premiums earned, and that's up 7.9%. This is solid growth. Growing way faster than inflation. And if we also look at their net investment income, this is another thing I like to look at. But here's the main point I'm trying to make here. So here was the free cash flow of only $107 million. Let's ignore the quarter before where they made $756 million. That's how they can afford the special dividends. And this company actually has a free cash flow yield of 14.36%. So 14.36% of the entire market cap they make in free cash flow every single year. So they could have a 14% dividend yield hypothetically, but that's why they're returning so much money to the shareholder through special dividends and stock buybacks. So their dividend cost them 71 cents per quarter, and they make $18 a year. So the dividend is very well covered by the free cash flow and the net income. So let's actually look at the net income of $242 million. And their organic 2% dividend actually only cost them $52 million. If we can kind of see there, the other quarters, why it says $268 million, these are the quarters where they're doing these special dividends. And guess what? They're spending this money on special dividends, and they still have in cash $1.09 billion. And guess how much they have in debt? $1.48 billion. That's well covered. And this debt matures in 2030 at super low rates. Like, this company is doing very well financially. They're even buying back some of their own stock. And here are actually some of the dividends I've gotten from this company. So at the top here, you see the $16 dividend. But if we scroll down here, I own the exact same amount of shares. I got $57 in dividends from 23 shares. This was a special $2.50. And their normal dividend would only give me $16.33. But yeah, that's why those two are my two largest holdings. They have so much room to organically raise their dividend. And if you want to see why I own Public Storage and CubeSmart, those are two self-storage REITs that I own and love. Public Storage is my third largest holding. Check out this end screen up here. I go in depth into the self-storage industry that most people will find surprising. These companies are so financially stable, and I love the self-storage industry for so many reasons. But don't forget to drop a like on the video. It really would help me out a lot, and see you guys next time.